ASC 230 Cash Flows Training, Section 4 of 7, Investing and Financing Activities. Hey everyone, welcome back to The Explainer. So in our last lesson, we built a really solid foundation with operating activities, which, as you probably remember, is kind of the default bucket for day-to-day cash movements. But, well, what about the rest of the balance sheet? Today, we're moving way past the daily grind to look at how a company actually grows, scales, and funds itself. Think about it like this for a second. Your operating cash flow. That perfectly captures the cash generated from selling your everyday widgets. But what exactly happens to that massive multi-million-dollar piece of machinery you had to buy just to manufacture those widgets in the first place? And for that matter, what about the giant bank loan you took on to fund that purchase? I mean, these transactions are absolutely monumental for a business, but they clearly aren't your daily operating activities. So where do they go? Beyond operating activities, the two pillars, investing and financing. To figure out where these big items belong, we rely on these two pillars to perfectly categorize all those massive, balance sheet-altering transactions. Let's dive into the first pillar right now, investing activities. This category relates entirely to acquiring and disposing of long-term assets and investments. Basically, here is your very first litmus test. When you're looking at a transaction, ask yourself, does this involve a productive asset or an investment that's going to generate returns over multiple periods? If the answer is yes, you are looking at an investing activity. Okay, so let's talk about the cash actually coming in, our investing inflows. Say you sell a piece of property, plant, and equipment. The full proceeds go right here. Remember from our operating activities lesson how we stripped the gain out of the operating section? Well, this is where the actual cash you received finds its true home. You're also going to see inflows from selling investment securities or, say, collecting the principal on loans you've made to third parties, or even insurance proceeds if a long-term asset gets destroyed. But keep this in mind. Loan collections here are for the principal only. The interest you receive, that's generally going to be operating. Now flip that around, we have our investing outflows. This is when the company is spending hard cash to build for the future. The really obvious one is purchasing PP&E, like, buying a brand new manufacturing facility. But it also includes things you might not immediately think of, like capitalizing internal use software development costs during the application development stage. If you're building software to run your business, or buying external intangibles like patents, that cash going out is an investing outflow. This bucket also covers making loans to third parties and the cash paid to acquire whole other businesses. Which brings us to the second pillar, financing, funding the business. So the big question is, how does a company actually pay for all those new facilities and business acquisitions? Financing activities are the transactions that change the size and composition of the company's debt and equity. Which means, here is your second litmus test. When analyzing a transaction, just ask yourself, does this change a long-term debt or equity line item on the balance sheet? If it alters the company's capital structure, it is almost always going to be a financing cash flow. Let's look at where that money actually comes from. When a company issues new common or preferred stock, the cash they receive from those investors is a financing inflow. And the same exact logic applies to issuing long-term debt. If you take out a massive bank loan to fund your operations, the gross proceeds sit right here. Even the cash received when employees exercise their stock options counts, because at the end of the day, you're raising capital, and that cash is funding the business. Conversely, the outflows in this section show how you return that capital or service that debt structure. Now, the absolutely crucial point here is that when you make debt repayments, we are talking about the principal only. Just the principal reduction goes here, and that same rule applies to the principal payments on finance leases. We also see cash going back to the shareholders through share repurchases and dividends paid. Interestingly, even the initial debt issuance costs that you pay when you close a loan are classified as financing outflows. All right, crucial classification traps. Don't fall through the trapdoors. I really need your full attention for this next part, because while the rules we just covered might seem pretty straightforward, ASC 230 has these borderline items that consistently trip up even the most seasoned professionals. Honestly, these are the exact kind of headaches that lead to incredibly painful audit restatements. Looking through the source materials, three major classification traps emerge as the absolute most common culprits. First up, the M&A restricted cash netting error. Second, misclassifying capitalized interest. And third, failing to properly split finance leases under ASC 842. Let's break these down one by one so you don't fall into them. Trap number one happens right in the middle of business acquisitions. When you buy a company, you show the cash you paid net of the cash and cash equivalents you acquired with the business. Makes sense, right? But here is a massive red flag. You do not net it against restricted cash. A super common error is taking the purchase price and netting it against the total cash of the acquired business, including those restricted amounts. The cause and effect here is simple math. Netting against restricted cash mathematically understates your true acquisition outflow on the statement of cash flows. Seriously, don't do it. Moving on to trap number two. Generally speaking, the interest you pay on your debt is an operating cash outflow. But if you are constructing a qualifying long-term asset, let's say you're physically building a brand new headquarters, and you capitalize the interest during that construction, well, that cash outflow is not operating. Capitalized interest actually follows the asset being built straight into the investing section. It literally becomes an investing outflow. Trap number three is basically an artifact of old habits. So under ASC 842, we have operating leases and finance leases. Operating lease payments, those are entirely operating cash flows. There's no split required at all. But for finance leases, the rules are incredibly strict. You have a mandatory split. The principal reduction portion goes to financing, and the interest portion goes to operating. A lot of professionals get kind of lazy, carry over pre-ASC 842 habits, and just dump the entire finance lease payment right into operating. You can't do that. It's a mandatory rule you absolutely cannot ignore. You have to split it. Finally, before we wrap this section up, I really want to drill home an absolute, unbreakable rule regarding dividends. The source material is remarkably clear on this point. Dividends paid are always financing. There's no election available. There's no clever accounting workaround you can use. If the company is paying out a dividend to its shareholders, it's a financing outflow, period. Please let that stick permanently in your memory. Master your cash flows, preparing for ambiguity. All right, let's take a breath. You now have a really robust framework for operating, investing, and financing activities, and you know exactly where those dangerous trapdoors are hidden. You know that investing activities are all about buying and selling long-term assets, and financing activities track the changes to your debt and equity structure. But what happens when a transaction doesn't neatly fit into one of these buckets? Think about complex derivative settlements, or maybe strange debt prepayments. In our next explainer, we are going to dive straight into the Master Classification Decision Guide and learn the framework for any transaction that dares to be ambiguous. So, are you ready to tackle it? Trust me, you won't want to miss it. See you then.